If you had $1,000 to invest in 2025, how should you do it? Today, I'll walk you through 3 complete portfolios designed for different risk levels that you can start with right now. We'll cover a safe, low-risk option, a balanced growth strategy, and a high-risk, high-reward portfolio. No fluff, just real, actionable strategies you can use today. Portfolio 1. The safe and steady approach. This is for someone who wants peace of mind while still growing their wealth. The focus is on capital preservation and beating inflation with minimal volatility. Here's how I'd split $1,000. 40% high-yield savings or money market account. Around $400 in a safe account paying 4 to 5% annually. This keeps part of your money liquid and risk-free. 40% US Treasury bills or government bonds. Roughly $400 in short-term T-bills. These are backed by the US government and currently offer 4 to 5% yields. 20% low-cost index fund like S&P 500 ETF, VOO, SPY, or IVV around $200 here. This provides exposure to the 500 largest US companies with minimal fees. Why this works? Your money is protected, you earn steady interest, and you still have a small stake in the stock market for growth. Portfolio 2. The Balanced Growth Plan. This is for investors willing to take moderate risk to get better returns. Here's the breakdown. 50% Broad Market Index Fund, VTI or ITOT $500 here spreads your investment across thousands of US companies. 20% International Stock ETF, VXUS or IXUS $200 for global diversification. 20% Bond ETF, BND or AGG $200 in bonds to reduce volatility and provide income. 10% Sector ETF in growth industry, $100 in a sector like technology, XLK, or clean energy, ICLN, to capture potential high growth. Why this works? You're balancing stocks and bonds, spreading your risk globally, and keeping a small portion in a growth sector for upside. Portfolio 3. The Aggressive Growth Strategy. This is for those comfortable with high risk and potential short-term losses in exchange for high long-term returns. Here's the split. 60% Growth Stock ETF, QQQ or VUG $600 in top-performing large-cap growth companies, heavily weighted towards tech and innovation. 20% Small Cap Stock ETF, IWM $200 in smaller companies with high growth potential. 10% Emerging Markets ETF, EEM or VWO $100 in fast-growing economies outside the US. 10% Speculative Play, $100 in a high-risk asset like cryptocurrency, Bitcoin or Ethereum, a hot startup stock, or a thematic ETF. Why this works? You're going all in on growth sectors and markets, with the possibility of doubling or tripling returns over several years, but with higher volatility. Whether you're playing it safe, seeking balance, or going for aggressive growth, the key is sticking to your strategy and investing consistently. The amount you start with is less important than building the habit. So, which portfolio fits you best? Subscribe to MoneyMap 247 for more practical, no-nonsense investing strategies, and let's grow your wealth together. Underscore 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 underscore